So, how did you first get interested in the stock markets, Mr. Ackman?
First, you can call me Bill.
Okay, Bill.
And the answer is, I was vaguely interested as a kid, but not until I went to work in the real estate business, and became after I graduated from college. I guess I followed the stock market to a certain extent in college, but did not make an investment. Did not make my first investment until I went to business school.
And what was that first investment in business school?
It was Wells Fargo Corporation.
And what were the reasons for buying Wells Fargo? What was your thesis at the time?
So basically, I had worked in the real estate investment banking business for 2 years prior to going to Harvard Business School.
Mm-hmm.
And when I went to HBS, I opened a brokerage account, and I decided I was going to learn about the investing business by investing. And the only thing I knew from a career point of view was real estate, and to some extent banking, because I had worked in a real estate, helping arrange financing for real estate owners and developers. And I chose Wells Fargo because bank stocks had gotten obliterated because people believed the banks were insolvent because of the real estate exposure.
Mm-hmm.
But I knew that Wells Fargo was very conservative in the way they lent money, and I thought that the bank was extremely profitable. Kind of the core earnings of the bank were very profitable, and that once they worked through some losses, even in a worst case scenario, I thought wasn't going to be more than a year's worth of earnings, they'd be back to being very profitable again. And you were paying a very low price for the company, based on where the stock had gone.
Did you decide on a philosophy early on? Like, I'm sure that you read The Intelligent Investor by Graham, but did you consider yourself a value investor then, and how has that evolved?
Yeah, first investment book I read was Ben Graham's Intelligent Investor. It was recommended to me by a guy I met at a cocktail party who was a friend of my dad's, who was a good investor. And then that was the beginning of my value investing education.
Mm-hmm. So you went on to Harvard to obtain your Bachelor of Arts degree as well as your MBA, and then fast forward to starting up Gotham Partners. You've been said in the media that raising money for the fund very early on was like blind dating. Could you explain some of the challenges that you faced raising funds for Gotham?
Well, we were calling up people, most of whom we didn't know particularly well, endeavoring to get a meeting and pitching them on investing with two guys fresh out of Harvard Business School with no
Mm-hmm.
experience
Mm-hmm.
and no track record. So that's difficult.
And so was it at Gotham that you solidified your activist investment strategy? Is that what you decided that you wanted to do? You wanted to turn around companies by taking a hand in them, I guess, per se?
It just sort of happened by accident.
Mm-hmm.
It wasn't, I just was a passive investor, and I saw an opportunity for a company to do something that would create more value, and that, just made me into a shareholder activist. It wasn't planned.
And what was the most memorable investment for you, and what you created the most value for your clients through Gotham?
Well, the most memorable and the one in which I created the most value are probably different things.
Mm-hmm.
But the most interesting investment I made, one of the most interesting investments, was an investment in a company called Rockefeller Center Properties, which I made beginning in 1994. And it was a very high-profile asset, and with a relatively small amount of money, we became the biggest shareholder of an entity that owned the equity and a mortgage on Rockefeller Center.
Mm-hmm. Yeah, I remember reading about that. Was it Goldman that eventually they saw the value in it as well? It was later on. You had seen it first, and they started buying a stake in it. Is that correct?
Yeah, we ended up competing to provide financing to the company,
Mm-hmm.
backing from the Ziff family, but ultimately they chose Goldman Sachs over our transaction.
Okay. So then fast forward to present day, you run Pershing Square Capital Management, 18 billion assets under management. You're one of the highest profile and most successful activist investors in the world today. I'm interested now, so through Pershing, Bill, which companies fit your criteria for investment today?
The things we own.
Okay. So these are franchise companies. They've been around for a while, large cap. Does that fit the criteria?
I mean, for us, the most important thing is what we call business quality.
Yes.
We're looking for a simple, predictable, free cash flow generative, dominant company. A business that Warren Buffett would describe as having a moat around it. The moat is usually created by brands, unique assets, long-term contracts, market position, or perhaps some combination of all of these factors.
And so do you also look for companies that perhaps they're ripe for turnaround? You see more value in those companies, but they're not necessarily reflected in the market?
We've done a couple of real turnarounds, but in most cases it's about optimizing a business as opposed to completely transforming it. The most difficult transformation we ever attempted was unsuccessful, which was the JCPenney investment. But most of our investments, you're taking a great business that has perhaps gotten a bloated cost structure, or has not thought about its business correctly, and maybe overinvested in parts of its business, or not allocated capital correctly, or perhaps is lost focus and it owns assets it probably should sell.
Great. So the next couple of questions I have, again, because this book, Market Masters, will be published in Canada for largely a Canadian audience. There's three positions you've taken on over the years: Wendy's, Canadian Pacific Railway, and then Valeant, which I'd like to focus on. So firstly, Wendy's. Did you buy into Wendy's solely for the Tim Hortons asset?
We bought into Wendy's because it was undervalued.
Okay.
We thought that the Tim Hortons, the price you're paying for Wendy's, you were getting Tim Hortons. You basically, if you netted out the value of Tim Hortons, you're paying negative for Wendy's, right?
So
the market was focused on Wendy's declining business and weak same-store sales and rising beef commodity prices and mismanagement. And we were focused on Tim Hortons, which was an unbelievable franchise.
And had you had a coffee from Tim Hortons? I know it might sound like a silly question, but were you there before you invested in the asset?
No.
Okay. So why do assets like that continue to be undervalued? Why does the market continue to be inefficient in certain areas and not able to price things properly?
Some degree of complexity. The company in that case was called Wendy's. Tim Hortons had a very different kind of business model as being a pure franchise restaurant company, whereas Wendy's owned a lot of its own stores. The financial statements, the consolidated financial statements were difficult to not incredibly complicated to figure out, but I think hid some of the profitability of Tim Hortons was masked by the weakness of Wendy's. So, when you have the market, most stocks are valued based on people's estimates of next year's earnings, analyst estimates, and if you have a company, one business making $2 billion and another business, another subsidiary losing $1 billion, the market will look at it and say, oh, it's got $1 billion of earnings, but that's not the right way to think about it.
So you're looking at the break of value, and you saw that Tim Hortons was definitely a gem within Wendy's. But then, so you took steps to influence the board management to spin off Tim Hortons. Was management hesitant to spin off Tim's?
Yes.
Okay. And was that because of current shareholders of Wendy's that they didn't
look,
spin
I think
off?
that most CEOs prefer to run a bigger business. You can, if you take a more skeptical view, it's, CEO compensation tends to be correlated with the size of the company they're running. You get to paid more if you run a bigger business. You can also justify a bigger airplane. It's all incentives drive human behavior.
And we saw that Tim Hortons was a mass success.
Hold one second.
Yep.
1 second.
Okay. So Tim Hortons was a big success in the market once it had its IPO, I believe 2007. bought out by Burger King. Did you have a hand in that as well? I know that I think you do have a stake in Burger King, but was that any of your influence?
Yes.
Okay, interesting. Yeah, I saw in the media a lot of the focus was on Buffett and 3G Capital, but I just put the puzzle pieces together. I would assume that you also had an influence there. Great.
Well, I encourage them to take a look at Tim Hortons, but they did all the work.
Okay. And so, where do you see Tim Hortons in the next 10 years? Like, do you see them worldwide, and do you think it'll work out for them?
Hold on one second.
Yeah.
Sorry about that.
That's okay. So, do you see Tim Hortons becoming like a worldwide successful franchise? Like it's just located in, I guess, United States, Canada, some parts of the Middle East, but do you think they can make it elsewhere?
Yes.
Okay. So we'll move on then to Canadian Pacific Railway, CPR. So this to me seemed like a nice, like pure turnaround. So why did you invest? Why did you take a stake in Canadian Pacific Railway? What were the reasons?
Well, it was the worst run railroad in North America.
Mm-hmm.
It constantly disappointed its shareholders. The stock was sort of cheap as is, for good reason. And then we had Hunter Harrison,
Mm-hmm.
who we had worked with for several months, having him teach us the industry, and he convinced us that the problems were not structural, that he could fix them.
Okay, well,
So with the best railroad CEO in the world, and a cheap stock price, we felt we could create enormous value.
Mm-hmm. And what were some of the things that Hunter did, like so straight away, that you had him execute on to start turning around that company?
Well, we just let him loose.
Mm-hmm. Nice.
So we didn't tell him what to do. That he had done this 2 or 3 times before. So
Mm-hmm.
we let him. We stayed out of his way, I guess I would say.
So aside from installing able management to help a company turn around, what other elements are required to execute on this type of activist investment to work?
I mean, the key things are, one, finding a good target, right? A great business that's undervalued because of perhaps undermanagement.
Mm-hmm.
2, figuring out the right person to run the company. And then a big part of the execution is getting ourselves in a position where we can install that management and have meaningful influence going forward over the company. And that can mean negotiating representation on a board. It can mean running a proxy contest like in CP.
Mm-hmm. So Buffett is said to say that railroads can be a key indicator for the economy as a whole. Do you agree with that as well?
Sure.
Okay. From what CPR is telling you now, do you think that the next 5 years will be okay for the economy?
I'm sorry, go ahead.
Yeah.
One more time.
Okay. Yeah. So for example, if Buffett said that the railroads are an indication from the different results that you see from Canadian Pacific Railway, are you optimistic about the U.S. economy for the next couple of years?
Well, I wouldn't use the success of Canadian Pacific to conclude that the economy is going to do better.
Mm-hmm.
The success of Canadian Pacific, for the vast majority of the increase in the share price, is driven by the improvement in the profitability of the railroad.
Yes.
And the improved efficiency of the railroad, the improved asset utilization of the railroad, and by making the company more efficient, reducing delivery times from like Toronto to Vancouver,
Mm-hmm.
They're now more competitive with other alternatives.
Yes.
And as a result of being competitive with other alternatives, they're winning more business, which is helping drive the revenues of the company.
Okay.
So it's a bit of an outlier.
Mm-hmm.
All right. So I would say I agree with Buffett. Assuming a railroad's being run well,
Mm-hmm.
obviously as it transports goods to, retail stores and commodities to, factories or consumers or, otherwise, that is obviously a pretty good indicator of demand and the economy.
So moving on now to the third Canadian company. So we started with Wendy's and Tim Hortons, that being the undervalued asset of Tim's. Then we moved on to CPR, which was the turnaround opportunity. What opportunity did you see at Valeant?
Valeant is an exceptionally well-run, extremely cost-disciplined, brilliantly structured company, run by a management team that has a strategy that we think makes enormous sense in a sector. There are very few players that operate that way.
Mm-hmm. So yeah, this is a case where the management was already there, and it was just a great opportunity to invest in. But I've seen that their acquisition strategy has been incredibly aggressive. The shareholders have definitely been cheering that on. But how long do you think that aggressive acquisition drive will sustain the stock's high multiples?
The stock doesn't trade at a high multiple of what we think of as its core earnings.
Okay.
And there's a lot of accounting complexity because they've done a large number of acquisitions. We think they don't need to do another deal, and they still have a very profitable business. But we think there are a large number of opportunities that can be done in the pharma space.
Okay, so you're looking for multiple expansion over the years, and I've seen the CEO. I believe has been quoted that he wants to be in the top 5 pharma companies in the world, top 3 or top 5.
I think there's a decent chance it becomes the largest pharma company in the world.
Oh, wonderful. Okay, so
we don't focus on scale.
Yes.
And nor does the CEO. He focuses on per share value.
Mm-hmm. So looking back at all these different Canadian plays, is this just a coincidence that you found opportunity in Canadian companies, or does this indicate that there's just better opportunity, there's less, let's just say, activity in the Canadian market in which you can capitalize on?
It's just we tend to focus on North America because it's close to home.
Okay.
You know, the language is English. The law in Canada is similar to the U.S. We've had a very favorable experience in Canada in pretty much everything we've done.
And do you limit your stock universe in Canada? Like, do you just look at the TSX 60 as the top 60 companies, just at large caps, or are you going to start widening it soon?
We need to focus on big companies because we're actually closer to $20 billion in assets today, and so we only want to do things that will move the needle. And as a result, we tend to need to focus on bigger things.
Okay, and this might be taken as a silly question, but how do you keep up to date on Canadian companies? Like, do you employ Canadians, or just to really understand the companies before you invest in them?
Yeah, hold on.
Okay.
Sorry. No. Well, do we employ Canadians? Yes. One of our traders just walked in. He's Canadian.
Oh, wonderful.
We've got an analyst who's Canadian, but I don't think you need to be Canadian to understand Canadian companies. So we do employ Canadians for sure.
Okay. What criteria needs to be met before you take on your next position in Pershing?
High quality business.
Yeah.
Fair price, and very cheap if we can make changes that fix the company.
And then before you take on that investment, do you set a target return that you want to see achieved to the stock within the first year, second year, third year?
No.
Okay.
Not a target return on a one-year basis. We focus on what's it worth, what can we make it worth, and how long is it going to take. I would say we have a few years out of what it's worth, not a year out.
No, and I'm not sure if you can disclose this, but would you be able to discuss some of the other Canadian investments that you were considering investing in but did not eventually?
We don't do that.
Okay, all right. Let's see. Are you aware of any of the activist investors, Bill, in Canada that do similar plays?
I don't follow them that closely, to be honest.
Okay, so there's a fellow named Prem Watsa. Fairfax.
I certainly know who he is.
Okay. Do you believe in that turnaround strategy where he's invested in BlackBerry and installed that very able manager, John Chen?
I've never looked at BlackBerry.
Okay. Okay, so another question is, how does a retail investor, how does a reader of the book without the means to be an activist, how does he or she identify a turnaround opportunity in the market, invest in it, but again, they don't have the means to then influence the board and whatnot to make core changes?
Well, that you can ride the coattails of shareholder activists.
Yep.
Pick your favorite activist, do your research, if you like the situation, you buy the stock and let the activists do all the work.
Fair, yeah.
And you'll have more liquidity, and you don't have to pay fees. That's a pretty good strategy.
So
you can't necessarily buy at the activist price, but you can, once they announce, you can. And oftentimes stocks don't go straight up, and there's an opportunity to buy it again at a cheaper price.
And then aside from following your bets, who else would you follow in the market? Like which other money managers?
So I think Value Act has done a good job. I think Tryon has done a good job. I think Jana, there are a lot of good activists. I think Dan Loeb's had some good success. The usual suspects.
Yes. Are there some sectors in the economy that is just more challenging to turn them around? They may seem undervalued, but it's just the challenges in that given sector that you would avoid?
Yeah, we've avoided businesses that are hard for us to predict with a high degree of confidence.
Mm-hmm. So I would imagine that be retail, technology.
Yeah, those have been big. Those have been. We've not been particularly successful in retail in recent years. We were earlier in the history of Pershing Square, but not later.
Okay. And final question, Bill. It would be for the readers of the book. The novice, intermediate, expert investors. What type of tips or advice do you have for investors out there?
I would really encourage people to invest in the highest quality businesses they can identify. Make sure you buy them at attractive prices and hold them for the long term. I think that's the lowest risk, highest reward strategy.